live on YouTube as well. We got a lot of inflation data this week with CPI and PPI, and kind of a little bit, softer than expected, reflecting probably in large part the lower gasoline and energy prices we enjoyed in June. But of course, with the resumption of activities in that part of the world, we just got oil pushing up higher here with WTI crude oil back near $80 a barrel. So that may be short-lived, but begs the question, how does the Fed think about inflation out there? David Kudla, he's the founder and chief executive officer and chief investment strategist at Mainstay Capital Management. David, I know you guys had been forecasting higher interest rates in 2026. Did the inflation data we received this week, did that change your outlook at all?
Good morning, Paul. Not really. We know that, we had a higher inflation read here a little while ago because of the Iran war and the spike in oil prices. And basically in June, what we saw is those oil prices come back down as much as 16%. So now we're seeing a little bit of relief as alternative routes were found, oil production was increased elsewhere, and some ships started traveling until recently through the Strait of Hormuz, started to see a recovery to some extent, not anywhere near pre-war levels, but oil moving through and Iranian oil sanctions being taken off for a period of time so that oil was making it to market as well. We're still concerned about inflation going forward because we're concerned about what we see now as a forever war in this Iran war.
Yeah, I guess that's my next question, because all the data and the earnings that we're starting to get and will continue to get, they all are up until June 30th. And that's when oil was at its low. And as we know now, in retrospect, it had bottomed. Since then, we've had the resumption of activity, as Paul so eloquently put it, and the Strait of Hormuz is clogged again. So does the narrative of inflation moderating broadly beyond oil still apply here?
Well, it's just going to depend on it to a certain extent. It's going to depend on, there are other inflation factors out there, but a certain extent is what happens going forward. Yeah, we saw through June oil come down into, the mid to low 70s, WTI, and we popped back up to the 80s very quick with this resumption of military action and very, very aggressive and hostile military action compared to what we had before the ceasefire. And we expect that to continue. And Iran continues to find ways to disrupt or intimidate in the Persian Gulf. And as long as that goes on, what do the markets want? What does the bond market want? What does the Fed want in terms of if it's about keeping rates low, or what do stocks want? No matter what the geopolitical or strategic outcome is, we just want, or the markets want, oil and other products moving through the Strait of Hormuz again until these alternative routes that come up, like the Saudi pipeline that was, the capacity was immediately increased, and there's other alternatives we're looking at longer term, but it's about getting that oil moving again. We've drained down strategic petroleum reserves to 1980s levels, more than 40 years, and are continuing to do that here and abroad. So we still face this concern about an oil pinch or a tightness of supply that it just has ripple effects all through the economy. And so until there's some light at the end of the tunnel on that, which we thought we had, but we have to see here, we're still concerned about inflation, so we're concerned about higher rates. The 30-year and really across the curve from the 2-year to 30-year, rates have been coming up. And we think that the next Fed rate cut, I know many think it's still a cut, or I'm sorry, the next Fed rate move, many still think it's a cut. It could very well be an increase in rates, as much as we think Kevin Warsh has marching orders from President Trump. That's yet to be seen, but we think there's just a lot of concern on the horizon about inflation yet.
So, David, how are you approaching kind of the market here? We had AI has been a dominant theme for this market, but it's I think diffused how investors look at AI. It used to be let me just buy the chips and I'm good there. How are you approaching AI as a theme in this market?
Yeah, well, Paul, interestingly enough, as much as the prices went up until, this, recent setback and recent volatility, earnings had come along so far that the valuations on some of these names just aren't that stretched. In fact, they're actually pretty low on a historical basis because earnings, and we expect earnings continue to be good. I mean, we're going to have these spats of what we've had the past weeks, and it may be for months at a time where there's concern about the excessive debt that's being taken on and this capital spend, and will it pay off? But AI is the future. We're all using it now. We're all using AI agents. We're all using AI. We're incorporating it into our businesses. We know where we're headed. And we see other opportunities in the market, but we're sticking with those AI names that we've talked about before that we think should still be the core part or one of the core parts of an investor's growth portfolio.
All right, David, thank you so much. We appreciate that. David Kudla, founder, Chief Executive Officer, and Chief Investment Strategist at Mainstay Capital, joining us via Zoom from Troy, Michigan.